I see some green shoots.
We need to have some kind of stupid bar.
I just think this is a classic structure, Lamont.
And I'll show you guys, a little trick here.
When you see some of the stuff that we're working on, you're going to like it.
Welcome back, Wyckoff Nation, to the Wyckoff Market discussion. Today is October 11th. This is session number 41 of year 2023, episode 372. Let's quickly go through the curriculum as we usually do. On Mondays and Tuesday, Wyckoff Trading Course Part 1, Part 2 with myself. This is where we study in depth the Wyckoff analysis, and also we practice developing the skill of visual recognition and execution. So for those of you who are guests and you are new to our community, please check those out on our wyckoffanalytics.com website. Also on Monday, together with William Riordan, we conduct the tape reading lab in the mornings, highly entertaining, highly advanced sessions on chart reading. Bias Game, our very popular educational tool, is being released on Tuesdays to our practicum students. And then on Wednesdays here, together with Bruce for the live market discussion, and on demand with Alessio for the crypto discussion. On Fridays, Alessio is publishing his new Wyckoff market report. We had really good feedback on his report, so guys, check it out. And then on Fridays, we usually read and watch Bruce on Power Charting, his blog, and the Power Charting TV episodes on Stock Charts and Stock Charts TV. Over the weekend, catch our communal Wyckoff watch list for your selection purposes, and also watch the Anatomy of the Trade together with Franz and myself. I want to tell right away, people who are guests for today's session, if you like what you see and you decide, well, I want to be a part of your community, then you have a really good opportunity to join us before the next session next Wednesday on October 11th at the promotional rate of $79 per month. So go to our website, wyckoffanalytics.com, find Wyckoff Market Discussion, sign up before next Wednesday, and we're looking forward to see you as a member of our community next week. Also, I want to do a quick announcement on the intraday and swing analysis and trading specials that are coming up. Registration will open next week, but so far we have the dates. We're going to start intraday on November 20th, and then with the swing, I did something different. We're going to do just one day in December for 6 hours, kind of like a workshop environment. I'll explain more during the next session next Wednesday. Bruce, how are you doing today?
I'm good, very good. Thank you all for being here. This is exciting.
Absolutely.
Looking forward to it.
Absolutely. So we've got so much to cover today. So we're gonna start right away, and we're gonna have a really good pace. It's gonna be a really interesting, entertaining class. We're gonna cover the majority of assets, and we're gonna also play a game. For those of you who are not familiar, what games are we playing? You kind of have to stick around to see what we're gonna do. With that, Bruce, the first chart that we're gonna discuss today is the chart of the Dow Jones Industrial Average, and both of the charts are long-term charts. So the first one on the background is showing you the Dow Jones Industrial since 1920, and you could see the big recession, the Great Depression that we have had back, in the 1930s. And then look how we're going up from there. We have moments when we're just going up. We are rallying. So what is it? What is this environment? This is a secular uptrend. And usually secular uptrends are going to be associated with, on this long-term level, with some kind of very driven by consumer earnings of that generation environment. So silent generation. Then we have baby boomers. And now we have, well, millennials and Gen Z. right? So let's combine them together because they're both already coming. If millennials are obviously already earning a lot of money, then Gen Z is coming into that workforce. And you could kind of see that it takes a long time, around 25 years to cover that distance, 25 years or so to cover the distance. We just really early, we're like in the middle, like 14 years or something like that, since the 2009 low, secular low. And when we are thinking about the structure of the uptrend, sometimes we could make some kind of comparisons. Definitely, we want to relate everything to the boundaries of the up channel, and Bruce will discuss this on the chart below. I just want to point your attention to one event. COVID looks awfully the same and kind of appears somewhere in the early part or into one half of the secular uptrend. So this is like a big view perspective for you of where we are. We obviously are mostly caught up in the minutia of every day, but this is where we would, from time to time, once a month, once a quarter, we'd like to look at those long-term charts, and today we're doing that. Bruce, could you discuss this part of the chart, the last secular upswing?
Well, the chart below is the Dow Jones Industrial Average monthly. And I've actually done these long-term trend channels for most of the major indexes. We've shown them in the past, don't have time to cover them all today. I have an amazing one for the New York Stock Exchange composite that goes back. The anchor points for the trend line are 1974 low, 1982 low. Tells a very similar story to the one we're looking at here with the Dow Jones Industrial Average. And this is classic Wyckoff construction, because you see those two boxes there above the upper trend channel line. That is called reverse use of trend lines. You draw an adjacent highs connecting those for a trend line, and look how beautiful that worked starting in 2011, and then 2013 was the second of the anchor points, and it sets the stride for the advance. And note the overbought conditions that occurred as we got further and further. Finally, with the 2021 bull market peak, it lived up there on that overbought supply line for almost three quarters of a year before tumbling down right to the bottom of the channel. The bottom of the channel is constructed by the intervening low between those two anchor points, and it's parallel. And look at how well it worked to identify the oversold conditions in the market. Even in the 2020 COVID low, it could go below the trend channel, but it couldn't live down there. Turned back up in short order, 2 months, and went right up to the top of the channel. So now what you see in 2022, October low, set another important low. I talked about it at the time and said, it's on the edge. It's got to rally. It's got to come back in. But in fact, what has happened is it's come back in and rallied to the midpoint of the channel, could not get back to the top. And that, I believe, is inherently a sign of weakness. It's back down to the bottom of the channel. It's stuck there. It has rallied here a very recent in October to stay at or above that trend line, amazingly. And I say this, hopefully, I'm using the term hopefully, it can rally back up into the channel. But my concern is that it comes out of the channel, because it's just pretty much living in the bottom half of the channel now. It comes out to the downside, and then it can go to the larger channel area, which Ramon has drawn on the chart above. So those would be the key high points I would say for this. And then if you have time, do go back and look at that NYA chart. It tells a very similar story, but more than about a 50-year long trend channel. It's quite remarkable to look at.
You could definitely use quite a lot of analogs here. There's so much history. Look into this area right here. What an interesting idea that we could go into the overbought condition, then we could actually rally above it. So this is a very, very important point. Rally above it, and then do what? Do some kind of, maybe like a recessionary dip, and we'll talk about the yields, the inversion, what it shows us. So imagine something like this structure. Then this retest of the long-term support line might also retest actually the COVID line. I know it kind of like looks so strange, but the retest could be much, much higher. And then the other analog, as I mentioned, 1987. So if you have this very, very volatile low here, look at how we're overcoming it. We are making the new high. So here it is. And then we go and we create again some kind of decline, and we recover from that, and we recover like this. So this is your bullish scenario, and this is your possible bearish scenario. All right, let's go further. Let's now discuss all of the indices. Apologies, this is the wrong title here. This is S&P 500. This is a daily chart. We also have a PNF chart on the right. And Bruce, why don't we start with an idea of that in the environment that we've identified, and we've been talking about the bullish environment actually since May, that we're going to go into a bullish environment in the trading range. And then we had our confirmation in this area right here. We said that this is a bullish environment, and then confirmation was the breakout. Now, we'll talk about the uptrend and all other features, but more importantly, when we have a reaction, we usually would take the PNF count and we would be counting the potential of the decline. Bruce, what could you tell us about the potential of this decline? Did we fulfill it or not? And if we did, then what does it mean?
Well, these counts, what I like to do is I like to take the more conservative count, particularly as it relates to distribution counting. And this count here would be and notice the hinge or the wedge right as it broke down. Yeah, it's absolutely beautiful there. So it consolidated and hinged into that area, fulfilled or completed the count, and then failed. And you can see 16 columns across, one box reversal. This is what I would call a swing count. And we set a range of objectives for 4260 down to 4140. And in fact, we went right into the middle at 4220. And what I find encouraging about this chart is, and good point to show the diminishing volume on the decline into the tests of that big down column where the volume was, big supply present, and then the tests had diminishing volume, which was bullish for a rally. The rally that's come off that 4220 low is pretty robust. It's a really good rally, which to me suggests that that count was a good count. And so, and we're going to go into more detail on other indicators here in a few minutes. But the only caveat I would have, because Ramon, I think this is a very good thing to see this rally here, is that it could be a larger distribution structure. And you could see that this may be a rally attempt. And note that the volume is not real good yet on this rally up that we've had in this last good bullish column. And it may be that we have a bigger count that's forming and for distributional purposes, and we'll just have to wait and see how well this market can rally off of this level. But so far, so good. And I'd like to see some more volume coming in.
Let's talk about the facts of the chart. I love to talk about this. It's just basically an invitation to see the reality of what is unfolding and not kind of like trying to figure out any of the scenarios before we go to the scenarios, right? So what do we see, guys? And please feel free to answer as we talk, as we speak. Bruce and I, we ask questions. and our audience usually answers. So for those of you who are guests, you're welcome to do that. So what do we see, guys? Higher highs, higher lows. What is it? Is this a conventional TA definition of an uptrend? Yes, indeed. So we are in the uptrending environment. Did we break that uptrend? Did we break any type of structure? Well, some of you would say like, well, Ramon, what about this? Didn't we break this structure right here? Yeah, temporarily, we went below the support, and look what we've done now. We're recovering, and we are already slightly above that support. Okay, well, if this reaction was only damaging maybe on S&P because NASDAQ looks differently, on the short-term basis, what's happening with the long-term uptrend, or rather intermediate uptrend? Well, we had our points of interest, and they all coincide with the support and the resistance. And look at the volume signature that corresponds to these points. What have we seen in the most recent price action where the price tried to go down? Effort has increased to the downside, but yet we had a very limited downward result. And the same happens here during the banking crisis. The same happens here in September, October of 2022. So volume itself is a confirmation that we are at a very, very important, significant point. So for those of you who are bears, I would say it's pretty simple here. You just have to wait for the break of more meaningful structure, and that would mean a break of this support right here that acted before multiple times as the resistance, and now it's acting as the support. But so far, we haven't seen that. So the facts of the charts is that we're still in the uptrend, and currently we are in the trading range. Bruce, any other observations on the S&P?
Only that, and we'll come back to this later, is that as the market has gone down from the top of the channel to the bottom, that we've had some great reversals in sentiment. We've gone from extreme bullishness at the top to now measurably bearish among speculators and traders at the bottom, looking at things like that. We'll look at that in a minute. But that is what we would hope to see at these returns back to the bottom of the channel. And then we also look for oversold condition and reversal off of those. And we'll talk about that. But this, I think, especially the way sentiment has reversed so dramatically towards concern and pessimism, I think that's a really good sign, Ramon. And I want to make this point really carefully, that it's a really good sign that the uptrend is still strongly in force.
Mm-hmm. By the way, I'm
yeah,
sorry.
Go ahead. No, go ahead.
Another question that I had from students in the last couple of days: the volume is going down. What's happening? Isn't this bad, right? Because the volume by TA needs to confirm the price action. Okay, again, these areas are very, very important right here. They are analogous. They are the areas where the price recovered before in the same type of the conditions. So what are we seeing here, especially with the banking crisis? We're seeing the volume going down. Why does this happen? All right, well, if you're not familiar with this concept, attend our WTC1 and, we'll study it together. Whenever we have buying on the way down, which happens in all of the three cases, you see how the volume goes up into that low. This means that the hidden demand is producing already absorption. Those are institutions buying, establishing their positions. The same behavior we're seeing here. So once they've established that buying on the way down, they don't need to buy more. And that's why the volume signature goes down. So the key in this environment is just to see the progression of the price with the local higher highs and testing higher lows. So we could have something like this and then continue. And there are quite a few bullish scenarios that we could discuss here. I mean, the first most obvious, what if we just go to the resistance right here, then have, instead of the lower low, a higher low? That would be a price structural change of behavior. And if we go up, we would confirm after the change of behavior and the test that finally we're getting out. And think about the analogs to this. I mean, like think about 2010, 2011, 2015, 16, and everything else on the way up, 2019. I mean, like there are so many examples where you're gonna have that short-term weakness in the uptrend, and until the uptrend is actually broken, you have to stay true to the facts of the chart. Let's go to NASDAQ, and Bruce, NASDAQ
So there
here.
was a good question from Stinley on, he wants to know how much volume is needed. You sort of addressed that, I thought. And
Yeah,
the only thing I would add to that comment is that it might very well be that we don't get an expansion in volume until after the test that Roman just drew on the chart. But the thing is, we don't need a lot of volume. A lot of volume can be a sign of an exhaustion of an upward trend. What we want to see is we just want to see generally improving volume compared to the recent past. So you see volume coming in as money is starting to flow back into the market. And like I said, that may not come until after the test that Roman just illustrated to us. So, and Roman, you may have other thoughts, but I thought that was just a really good question.
How about this? And let's just move on to other things because we've got so much to cover. We have to keep the pace on. How about this? Guys, look at NASDAQ. What do you see? You see a downtrend. You see a trading range that changes the environment. This whole area right here, and including this rally right here, by the way, this is your first change of behavior that was negated. And then you have another series of rallies and then the test of those rallies, and you have confirmations on the way out. So you're changing the bias around this area right here. Obviously, you know, for us Wyckoffans, we've been talking about the structure since the beginning of it. And when you look at what happens next, this is an uptrend, higher highs, higher lows. And this is the strongest asset. Look at the dynamic rally. Do you think that after this type of rally, we're gonna have like immediate distribution? Do you think that institutions have been accumulating their positions for 6 months in 2023 since the beginning, and even earlier to the left of the formation, and they're gonna just dump everything right now? It has to be something very, very important that would move the market and the economy in a completely different direction. And yes, it's a possibility, but so far, Bruce, I don't see anything out of the overbought, overthrow condition after the change of behavior, which is not bearish, even though supply is coming in, supply is increasing. But how much of the rally are we retracing? We're retracing maybe, I don't know, 25%. How about this? 21.8%, something like that. And then after that, it's all trading range and it's horizontal. There is really nothing too bearish about this. And if anything, the strongest asset is showing buy and demand is coming in on the last rally, and how dynamic this rally is. Much better than this takeoff that had that very interesting test on increased effort. So Bruce, so far, I don't see anything that would tell me that this is a distribution. That's number one. That the uptrend is done. That's number two. This is suggestive of the continuation, at least for now. And I know that my line in the sand is going to be this support. If it's broken, then I'm going to be concerned. Then I'm going to be thinking, should we change the bias? But so far, we don't have that. So with that, Bruce, did we fulfill the objectives to the downside? And then in terms of like, what is the potential here if we're going to have a continuation?
Well, one comment that I think is really important about this structure, we have a beautiful accumulation type structure, which I've counted below, and I'll show it to you in a sec. But that from 23 back to the spring of 22, you can see this really beautiful accumulation type pattern and a rally up and out, NASDAQ being the strongest, and it went right up to the resistance level. And when it stopped at that resistance level with some climactic behavior, it didn't just go down and show a weakness. It created a flat structure, which we would consider to be likely reaccumulation. And so reaccumulation is a favorite pattern of mine because these happen repeatedly in ongoing uptrends. And so a flat reaccumulation is in my mind, a bullish event. And it's likely unfinished, but so far so good. But what I would say, if we look over at the point figure chart on the top right, is that that is an attempt to count a local distribution structure. And I want to make a really important point. This is a swing trading count. These point figure counts can be fractal, meaning that you can have them occur in smaller time frames inside of larger structures. So that's a one box reversal point figure chart for those of you that do point figure. And what I've done is I've taken the first reaction high back to the highest high where the number 19 is, got 19 columns across, it counted down. This is a scale of 50 points, counted down to 14,950 to 14,650. And notice that that came within, well, it actually came exactly down to the low of that initial decline. Then you have a rally up, and it comes back down and slightly takes out that 14,650 area, and but it can't follow through, and then it turns back up with good strength. So there is a count there that has been fulfilled in that last decline and a fractal type basis, and I believe that that suggests that this may very well be the extent of the decline. But caveat is, look at the where the rally's gone to. I've drawn a gray arrow there. That is up to 15,250, and that is what we would describe as preliminary supply. And what we want to see from a bullish perspective is for it to be able to go there, stall, or completely ignore it and just keep going up, but not pull back. Because if it starts to pull back with any kind of veracity and weakness, then we would have to consider Roman's concern about the potential for a breakdown below the lowest lows of that 14,450 area. And
By the
I'm
way,
not predicting it, but it's there.
But just to make sure and to clarify, like kind of like my position on this, I think what has transpired in the last week or so, right, since the low, is actually telling us that there are lower probabilities for any type of like shakeout now. It could be in the future, but the way how it all unfolded, I think that we actually trying to figure out what kind of rally we could produce here. And Bruce,
Yeah.
quick question for you. Especially on the PNF, we're seeing this line right here. We come to the resistance. If this line is broken and the price comes back to the resistance right here and overcomes previous high, how do you interpret this? Bullish or bearish? I mean, like, with the possibility like of, are we gonna still talk about the last point of supply, or we just establish that this is
No. Yeah, well, that would pretty much negate the idea of the last point of supply. And the other part of it is that because we're dealing with an ongoing uptrend, I always default to the idea that the primary trend is in force. And so there isn't anything in here that suggests that the trend's been negated.
Yeah.
And
use the facts, guys. Look at the trends, and then if the character changes, if preconditions for change are there, expect that change might come. But if it doesn't come, stay with the current trend. Bruce, I think the most fascinating index is Russell 2000. I mean, like, there are so many stories about that. I mean, we had the banking crisis, and it was definitely weaker than any other indices just because of the constitution of the index itself. We're seeing again the weakness, which is very pronounced. And at the same time, look at the trading range since May that we started talking about, being bullish. For the upcoming structure for S&P and NASDAQ, Russell is just like, does not want to get out of this structure. So how would you even approach this chart from the long-term perspective, or just looking at this trading range?
Well, it is fascinating. And again, going to that point figure chart, you can see the fractal nature of how point figure can work on a swing trading basis, one box reversal. Because all I'm looking at there in that that upward count is that little consolidation area from April, March, April, yeah, right across that area. And I have these two counts, and the smaller, more conservative count was struck at the resistance area, which is a classic place for it to go and stop. And then it formed a little distribution area that went right back down to the bottom of the trading range, and it went there, and now it's trying to reverse off of that 170 area on the IWM. But here's what I really like. So these little counts are really great for giving us an idea for the extent of the moves within a larger structure. Because I know many of you are asking the question, well, gosh, or you're making the comment, look at the size of this thing. What if that's accumulation? It's gigantic. And absolutely, that's true. But we have to, eat this elephant one bite at a time. And the thing that I really like about the last pullback that we've had from the late June high, the late July high down to the support area is that it took much longer to go from the high, the resistance to the support than the prior examples, which go back to 2022, August to October, February down to April, March, April, is that look at how quickly those declined to those areas. This is much more labored, and it took a long time. Now, what would I need to see next, Roman? Is I would need to see a somewhat of a change of behavior in the way that it rallied up to the resistance area, and that each one of the consolidations on the way up would be very brief and very shallow. And then I'd love to even see it climb above that 2020 area and show a sign of strength above that resistance area, and then pause there rather than coming back into the trading range. That would be, in my mind, the most bullish condition for the Russell. And until then, it's just range bound. And that doesn't mean we don't try to trade the bottom of the trading range if we think that this is the place to make a stand and put on a tranche, because we think in terms of tranches in Wyckoff. So we might put on a tranche down here and see how the market rallies up, with the idea that we'd put additional tranches on if it did all the right things. So we're always asking the question, what should this look like to suggest bullishness, or what should it look like to suggest bearishness?
Last three thoughts that I'm going to give you guys here. I really like Bruce's comment about decrease of volume and decrease of volatility between these two reactions. So look at the volume and look at the spread. Obviously less bearish, but still there is an ease of movement with which the price goes through very, very important levels of the support. So we know that this is not done by any means. Here is a suggestion, second idea. We're saying that S&P, NASDAQ are still poised to go up. We still don't see any distribution there so far, unless the structures that we're currently building are broken. Imagine the situation like we had in May of 2023. Do you guys recall what S&P and NASDAQ, and especially NASDAQ, was doing in May of 2023? Really quick pop quiz. Up or down? Quickly. Rallying, yes. So NASDAQ was rallying. Could it rally now while we're doing what in Russell? Being weaker, creating maybe a structure like this before we go up. So this type of weakness on the way down, even with ease of movement, still suggests testing at this level. There are some encouraging signs that it stopped here, and we need to see what kind of testing we're going to have. If the tests are weaker, most likely we're going to retest the lows. If the tests are more favorable, especially overcoming this level, because remember how much time we spent here and then finally overcame this. If we overcome this faster, that would be a much more bullish sign. All right, well, what about?
And I would just make one quick point about that, and that is that even though this is pretty interesting because of where it is in this its trading range structure, and so on. My focus is always on where's the relative strength, where's the leadership. Russell is not leadership. And so this is an interesting exercise to go through. It might even be worth like a small pilot position for somebody who's interested in the Russell. But I think that there's other places where there's much better potential and much better activity at this time because of what Roman just said about the strength of the NASDAQ and so on.
You could still trade Russell. You just need to be a little bit innovative, creative as to how you trade it. What about spread trading? You sell Russell and you buy NASDAQ. You buy the strongest and you sell the weakest. And then you're delta neutral. And with that, you're just waiting for the spread to increase and take the profit. So just an idea. Bruce, what about the Dow Jones Industrial? I mean, this is a very interesting structure. You sent me over the weekend, some analog that was actually even pointing down. That was an interesting look, was very much resemblant of what we're experiencing right now. Are we done with this decline? Do you think that maybe this is one of the last legs to the downside, or do we require maybe more testing here?
Well, the Dow is such an interesting index at this time because we definitely can see the NASDAQ composite, the NASDAQ 100, S&P acting better than the Dow is. And so here, in a way, it's just been range bound at the top of its potential accumulation area, while the NASDAQ has just been rushing ahead. And so this is an interesting place because there's quite apparent support right here, which is defined by the May 22 peak and the lows of November, December of last year, and so on, April, May of this year. There's a lot of support that has been defined in this area, and it's rallying quite well off of that support at this time. And so does that make this leadership? Not really. And I think that the same statement somewhat applies to the Dow as it did to the Russell 2000, in that we need to see the Dow be able to prove itself by climbing easily up and out of the resistance area, getting above the prior high of that 35,600 area, and be able to show signs of strength, very minimal, shallow, low volume pauses on the way up. And that would say that there's a change of character in the way the Dow is acting. And until that, I mean, this is the low risk place, I think, to be able to put on some kind of a trade in the stock, in this index, but because stops are closed. But at the same time, there are other places I think that are better. But the other thing I'd like to point out is that this distribution count, swing trading distribution count, 23 columns with a hinge there, counted down to 33,300, 32,400, and it went right into the middle of that range, and now it's reversing off of that very strongly. And the volume is expanding. See the volume expanding above the declining volume of the prior column. And so this could be something emerging that suggests the Dow wants to act better relative to the other indexes. It might start to act maybe as well or closely. And some of the sectors and industry groups suggest that these Dow old school type stocks might be catching a bid and acting better.
All right. Okay, last thought here. Think in terms of environments, bullish environment, but volatile, bullish change of behavior. And then what do we see in the actual trading range? Environment number 1, 1, 2, 3 decline. So definitely with a short-term bias to the downside. Next environment, a local high, low uptrend. And then the next environment is again 1, 2, 3 type of decline. So when we would compare this to the analogous decline, we could definitely see a couple of things. Volatility is less, that's number one. We are probably at this point right here where we are trying to go down. We have the rally. This is a better rally than this one, and we are stopping at a slightly higher place. So we could potentially have one more leg down. I mean, obviously this was on news, this was on catalyst, so this could be more muted, something like this, where we retest, maybe even retest a little bit more and then go up if we still in some kind of sustainable type of uptrend from other indices. By the way, one more thought here on the S&P, I forgot to mention this. What if this is a reaccumulation? Right? So we are saying like, for now, this is our main assumption. Then what is the target? Very simple, conventional one-to-one measurement brings us to what I like as an objective, 5,000 to 5,200. I think it's very reasonable, above all-time high. And the more important question, I think for both Bruce and I, is what's going to happen next, because that inversion of the yield, recessionary type of expectations, they will materialize at some point. I mean, like, we cannot escape it. It's just a matter of to what degree. All right. Well, with that,
could you take a second, Ramon, and go back to that NASDAQ 100 chart, which they had the 2-point figure right there. And so just to make the point, and by the way, I did do a count on that accumulation area in the NASDAQ, which is just this that area right there. And it counts up to 16,700 to 16,850, which you can see gets us right above the bull market highs. But now, so that's that count there, and this count could grow bigger because we rally up, and then let's say we put in a last point of support, or we put in a shallow backup at that 16,000 area, we could count that across, and the count could be even larger than this. But let me go down now. I apologize because I took this count on the triple Qs, and this is actually, oh no, go back there. So you can see this actually was a count I did back in June of 22, but I've updated it. I've added as we've gone, but this count went up to 388, and we went up to 387.9, something like that, and didn't get up to the 388 threshold, which was the minimum count objective for this initial what we call segment of this larger count. But look at if you take the whole count, because the NASDAQ, or the triple Qs, NASDAQ 100 is doing exactly what you would hope. It's consolidating in a tight sideways range. And we will be able to count that. We just sort of did with that 16,700 to 16,850 area count. But now we can take this larger base count, which is 23 columns across, 3-box reversal method, 4-point scaling, takes us up to 532 to 564, and goes way out, way above the highs of the prior bull market peak. Now, what that tells me is that there's fuel in the tank for new highs in these stocks, and so I will, be constantly looking and testing for the conditions that suggest the trend is solid and it's going to continue. So again, more fuel in the tank for higher prices.
All right, Bruce, we're talking about the possibility that the market might continue its move to the upside after some kind of pause as a reaccumulation. Do we see any confirmation of this in the market breadth? Because what I've been hearing in the last week is that everybody's still so negative on the market breadth. But wouldn't the market breadth be kind of low at the low of the reaction, and then it's going to start increasing? That's question number one. And then also another question that I have, wouldn't we make a judgment, an assessment as the price reverses the downswing and starts to go up, as to how market breadth is improving with which type of pace and acceleration?
Absolutely true on all accounts. What are the things we look for? We look for in the top pane, just for those of you that this is new to you, is a 10-day advanced decline oscillator. Just the net between advancers, decliners, 10-day moving average. The other one that's really important is the net volume, up volume to down volume, 10-day moving average. And then we can take and split those numbers out, up volume every day, down volume for every day, and we do a 10-day moving average of those. And that sometimes can give us a great little clue ahead of time by looking at the data separated of up and down. Anyway, so excuse me, the thing that we look for in both oscillators is overbought or oversold. We look for divergences, which we don't always get, and then we look for directionality. So let me just unpack that a bit. And that is that when you get an oversold condition, which actually started at the beginning of October, and you can see there on the NYA chart, New York Composite, that it started to turn up right after the beginning of October, new quarter, right? Very important. And we would tend to go with the turning up, the northward direction. And as long as that is pushing northward, we're going to give the trend the benefit of the doubt. And oftentimes what happens is that you'll see a high made in the indicator and then a lower high while you're making higher highs in actual prices, index prices. And that is a divergence. And it occurs in reverse. And we had some legendary divergences at the lows. For instance, the October lows. We had divergences early in 22 in I think it was April, May, and so on. We don't have them on the chart. But the thing is that we look at these, we follow them very closely. I've marked them on the charts. Didn't mark them all on the NASDAQ on the right, but you get the idea. And so right now, what do we have? And we talked about this, that we were starting to get these oscillators turning north last week, and we discussed that at the time. But you can see it's persisted. It continues to go up. So to me, that's just a very simple way of suggesting the underlying bias of the market is to go up, that the individual stocks on balance are rising, and the index is going to go along with those individual stocks in an upward direction. And this is going to go on until we get overbought, possibly a divergence thereafter. So this indicator worked terrifically in here. Mm-hmm. And so and that's really kind of in a nutshell what we're doing with this.
Bruce, what catches my eye, and maybe I'll have a question here, is this. Like on NYSE, the up volume is drastically up. So I'm wondering, what are we rotating to in there?
This could very well be the argument for the Dow Jones Industrial Average. I'm actually seeing some good internal relative strength activity in industrials, in sort of mainstream stocks that are economically sensitive, healthcare. In some of that area, I'm starting to see some good activity. So it could very well be, because many of those stocks are on the New York Stock Exchange, that this is where the dollar flow is. Mm-hmm. And it's encouraging to me.
Yeah, very encouraging. And then the other thing that I want to mention, this is not a question, but just an observation. Guys, look at the character, right, of all of these market breadth advances. I mean, definitely it shows a lot of strength. Also, I want you to notice, how much time does it take for the breadth to actually come to the market? And what does it even mean, market breadth is improving? Usually it means they're buying more than they're selling. So how long do they usually sell a buy for? Okay, so 1, 2, maybe 2 weeks, 3 weeks as the main pulse of the breadth. Then what happens next? Well, it starts to go down, right? So they're buying less, but it's very logical. Why would they be buying constantly? They bought in the position like yourself, and then what do they do? They sit on it, right? So with that, breadth starts to deteriorate because there is less buying. It doesn't mean that we cannot rally during those periods of time. So just
Sure.
an observation.
And then
Right.
go back for just a sec. There's one little nuance I want to point out. And we look at these charts periodically every few weeks. And note here in the late September peak, or the low in the index in the NASDAQ comp, and look at the peak in the down volume. So the down volume makes its peak with the initial low in late September, and then look at how that red line starts to really decline persistently steeply there into October. And that's on the volume. Excuse me. And look at how you get a test in the first week of October in the NASDAQ Composite Index. But by that time, look at how much the down volume has dropped. That shows that supply has dried up, that there's whatever selling was coming in that decline is exhausted. And the attempt to test came on greatly diminished supply. And so that's a little nuance that you can see in these indicators that prove to be very, very bullishly important on a local basis. And I just wanted to make that point.
All right, we're at 4 o'clock. Let's talk about the market breadth from the perspective of stocks above 50 moving average and above 200 moving average. So Bruce, what do we see here?
So same idea here with the 50 and the 200. These are breadth indicators. I absolutely love them. And all we're doing is we're just plotting the number day in and day out, stocks above the New York Stock Exchange that are above their 50-day moving average. On the left, the indicator on the right is stocks above their 200-day moving average. And we look for the same conditions we just talked about. We look for overbought, oversold, we look for divergence, and we look for directionality. So note late July that we got a divergence there in the stocks above the 50-day moving average in an overbought condition. Over 80% of stocks are above their 50. That is a definition of a local regional uptrend. And then look at how the decline, the number of stocks that are above their 50 just starts to collapse in the month of August. There, see it collapsing, it just falls. That shows that there's a correction in place. So we had a divergence at the top, and we had a returns southward. So we have overbought, divergence, and directionality. And so those conditions we have to go expect that in the index itself, it's going to reflect the weakness that's showing up in these internals. I love this indicator. I've been using it for, gosh, 40 years. And it's a very important indicator to me. And I don't have time to talk about that more, but you can see the divergences that are coming at points in the chart as defined by those arrows on the indexes and on the indicator. The 200, the only difference with the 200, same concept, it just moves slower because of the number of stocks. But here's the thing, the strength or the health of a market, I think, is very well defined in this indicator, because you want to see in a good bull market a breadth of stocks that are in positive uptrends above their 200-day. And I know you all look at stocks and look at their 200-day average. It's a very good definition of an uptrend. And so here, look what we did have. Now, I'm pointing out that from February to June in the S&P, you had a tremendous advance in the index itself, but look what happened to this number of stocks above the 200. It's actually diminished making a lower high in July than it made in February. And so that actually shows that fewer stocks were carrying the day for the index to higher prices. And then it started to go southward. And we have to, when it starts to turn down, we respect that. We go with the trend of that indicator, which suggests that the number of stocks above the 200 is diminishing. And sure enough, look at the decline. And it gets down to around 35. The only other point I would make on the stocks on the above the 50 is look at the October low right at the end of the quarter. Quarters are so important. And look, it goes to 15% of stocks on the New York Stock Exchange are above their 50-day moving average. That's deeply oversold. That's a vast majority of stocks that are below on a swing trading 50-day moving basis are in a downtrend. And so let me just point out, oversold in September of 22, end of a quarter. Oversold in mid-March of 23, end of a quarter. Overbought in the first week or two of July of 23, end of a quarter. So it's like we watch these so closely, these quarter end effects. That's all I'm going to say, Ramon. But the only other thing that's so phenomenal, look at the New York NYH stocks of other 200 into the last rally into the 2021 bull market peak. Look at the steep advance with a climax into the 21 peak. Note the number of stocks that are carrying that index up. It's diminishing, lower highs, lower lows, all the way through that last leg up. That's all I got.
All right. I'm going to show you a slightly different view of this. So this is just more data of the same thing. So this is stock charts, by the way. You do have those indicators on stock charts. So we have those impulses in breadth that are taking us, out of specific areas. And then we go into the trending environment. How does the uptrend looks on this chart? Like this, like this, like this, like this, like this, where volatility first is a little bit high, like it is here or here, but then volatility starts to go down. So we're looking for this as an indication of the maturation of the uptrend, and then we're looking for breaks like we had in 2014. Go look at that in October of 2014, or more meaningful breaks like this in 2019 into December. Okay, let's go somewhere else.
Yep.
Let's, Bruce, I don't know if we need to go through this. We're like at 4:07.
Yeah, we'll do that next week. But that was the chart we just looked at, which was stocks of other 200-day. We'll come back to that.
It just feels like a repetition a little bit. So let's just go to the new material here. Let's talk about the sentiment. So a lot of you guys were asking us about the sentiment. I've created here a much longer timeline from the CNN's Fear and Greed, which we use periodically and regularly, actually. And you can see here is the beginning of 2023, and we are definitely making the low that is very, very interesting here. This is a higher low in the uptrending environment, and it comes as I said, at the very, very important point where institutions are coming in and starting to buy. And yet this is the lowest, or maybe on par with this one right here. So sentiment does not work the same as the price. So even during the reactions of the uptrend, we could have a very, very oversold condition on the sentiment. And Bruce, I think this is what we are seeing here.
Yes, and I think sentiment's remarkably important because this tells you whether or not speculators and traders and even investors have lots of cash or they're fully invested. And what this suggests to me is, and the lowest number I saw actually for the Fear and Greed was like 23. It actually updates through the day. And but it's a terrific indicator. It's easy to look up CNN Fear and Greed. You can search on that and keep track of this data. And the fact that we just went down, this is what the comment I made earlier, which is having a flat correction in the indexes, relatively flat correction, and having the sentiment become so bearish in the face of that, I think is absolutely bullish. When you're in a good bull trend, when you get declines in a bull trend, the bearishness gets very high. Because I don't know why, people are just fearful. Joe Granville coined the term, stocks climb the wall of worry. Well, this very low reading in the fear and greed in an uptrend in these indexes, to me, says stocks are climbing the wall of worry. And so I'll leave it at that. We look at this indicator all the time. The other thing I'd point out is that very low reading, when did it come? End of the quarter. And so it's just classic how that happens. And more on that in the weeks ahead.
All right, let's go to the put and call ratio. This is a pretty long chart for us since 2009 low. Bruce, as with the sentiment, one of the things I was highlighting here, but look at the lowest points, right? So what happens after that? So the sentiment improves. Why? Because there are rallies. So this is just a reflection of this dip, and we should have some kind of, at least an attempt to rally.
And rallies occur because traders and speculators have cash and they get pulled back into a strong uptrend.
So then, Bruce, here we have kind of like a very interesting historical perspective of where we are.
Yeah. So we look at how we had extreme bullishness right into the July high of this really magnificent rally in the NASDAQ 100, which almost got to the bull market peaks of 21. And we got a high bullish reading in the equity put call numbers. And then immediately we get a reaction. Look at the slight reaction that we get in the NASDAQ 100, and the put call reading goes from extreme call buying to extreme put buying. And now this ratio is up to a level that's consistent with good lows in the market. And there we are. And you can see that we are in, unfortunately, this needs to be it should be flipped upside down, but a high number here in this ratio is extreme bearish sentiment, meaning a lot of put activity. So that means bearishness, which is consistent with the CNN fear and greed. And so I think this is generally a pretty bearish environment for the investment community, which is good for higher prices.
I could see here, Bruce, for instance, in 2020, as the price approaches this low, we're still going up. Here, we're still going up, right? Was this low right here? I'm just going through the lows that you've identified here. Yeah. We're going up, right? 2020 was definitely an outlier, kind of like, I want to say, artificially constructed, market. But at the same time, it's, any other.
Yeah, I have a whole theory about that big bulge of activity down there where it lived in the bullish area in 2020 and 21, the COVID rally. But it's not a discussion for today. We don't have time. But I think there's a really big reason why that happened. And but we're back to normal. It's now bounding between overbought and oversold. And I think you'll see sentiment is environmental. It's not a perfect timing tool. And so when we see extreme bearishness or extreme bullishness, it tells us what the nature of the environment is, but then we have to go to our Wyckoff tape reading sense to be able to interpret the appropriate timing. So I'll leave it at that for now.
All right, let's talk about the seasonality. We've talked so much about this, and as we're tracking the highs and the lows of the trading range that was suggested to us by the seasonality pattern, we're seeing that S&P is actually in slightly down sloping. NASDAQ is just flat, so it probably even better to use NASDAQ here just to kind of like go through the seasonality like this. And we know that October is going to be improving over September, and November and December should be much better months, going into the end of the year. I just, again, want to point out how seasonality was so accurate in 2022, and it has been extremely accurate in 2023. So I would give a lot of weight to this data. Bruce?
Yeah, and the only thing I would add to what you said, Roman, is that we got a July peak in the S&P. We got a July peak in the seasonality, and nice uptrend in the first half of the year. It shows the second half of the year into November being a range-bound trading range environment, and that's pretty much what we have. Has a slight downward tilt to it so far, but it's a basically range-bound trading range. And we have actually in the seasonality, we have the October. In October, we show a spring low of the trading range that started in July. And we are getting a spring low of some type, it appears, in the S&P 500. And we may get another one as a test, I don't know, but pretty amazing. And some of the best trading that we'll see here for a while is the period from November into January, February, and I'll put up the seasonality for next year as we get closer. But pretty amazing stuff. It's really helpful as a kind of a roadmap.
All right, 4:15. Let's try to get through as much as we can. Let's talk about the sectors, right? So we kind of understand where we are in what kind of price structure. So currently in the intermediate uptrend with the short-term consolidation. Obviously, during the consolidations, what is our job as analysts and traders? It's to understand what is outperforming, meaning that it's not being sold by institutions as much as underperforming assets. And what's underperforming? What is it that they are dumping right now? And Bruce, looking at all of the sectors, which one or maybe a couple of sectors that catches your most attention from the point of view of bullishness and outperformance?
Well, the ones that really stand out to me and continue to do so is technology, top right, communication services next to it on the left. I think that those look very constructive. Look at this range-bound environment in communication services and a slightly higher low in October from August, and the quality of the rally that's occurred after that would suggest that this is a nearly completed range-bound condition. I think that's very constructive. And then the next thing, so technology, higher low on relative strength, pushing up to the relative strengths pushing up to the prior highs. And it's been relatively range bound, slight springing action late September, and now it's rallying pretty robustly. The other one that's a little bit less, more nuanced would be to look at industrials middle left. You can see that it's been pretty weak into the end of the quarter, but often at the end of the quarter is where you get really important reversals and a really good rally off the early October low. And the relative strength, look at how the relative strength is trying to make a base there. And so I think that that's one to really keep an eye on and look for leadership in the industrials to see if there's some stocks in there that are really leading the way. And then healthcare, kind of a similar note, higher lows in the relative strength since July. I think that's constructive. And look at the quality of the rally upward in October. That's among the best rallies we've had since the July peak. So anyway, so those are, I think, highlights to me.
All right, great. I can't add anything else to that. Those are my favorites as well. Just, one thing here to mention, look at the staples. So very steadily in the downtrend. Look at the real estate, but there is some kind of change of behavior that is happening right here. What else? Maybe materials here as well. All right. Let's look at the mega cap 8 stocks. So those are Apple, Amazon, Facebook, Google, Microsoft, Netflix, Nvidia, and Tesla. So those are big stocks except for Netflix. Now, Netflix capitalization is smaller, but it's a regional FIANG stock, so we keep it. And now, Bruce, kind of the same question, but let me go first. What are the interesting candidates here? And in the last class, we looked at them. We often look at the stocks because they influence in the moves in the indices. And we said that this four right here, Facebook, Tesla, Google, and NVIDIA, are the ones that are outperforming. You could see where the price is relative to the first initial stop in action. And we kind of seen that with an exception of Tesla, all of them are actually already showing either the new high today or they are higher than the stop in action itself. And Tesla is somewhat close in the apex formation. So this four is definitely to consider. And then you have the other four where also there is a lot of interesting things happening, except again, for Netflix, we probably will just have to go to Magnificent Seven, Bruce. But looking at Microsoft, look at this takeoff, look at this relative performance, look at Apple, how it recovers out of the sprint position. And also Amazon is kind of like still in the trading range right here. But Apple and Microsoft also are probably the second tier of interest for me, Bruce.
I love it. And the thing about these stocks, it's like they amaze me. They never cease to amaze me. But reasons are optional. It's really tape reading. I'm looking for leadership. These stocks have all made range-bound reaccumulation type structures, and you have some that are actually stellar, like Google, which throughout that whole period is making higher highs and higher lows. And look at the relative strength in Google. I mean, it's just, to me, is best of breed. The next one is Meta stock. Is Meta, and not Meta stock, Meta. And look at the hinge. It's making higher lows throughout the range-bound condition, and then a resolution of that hinge with a really good move to a new high above the July highs. And the relative strength is just, really epic. And so I love that. Microsoft, bottom left, is just made a spring type lower low in late September, right into the end of the quarter. Now it's acting really well. And what's important to me is you had a higher low at the late September low in the relative strength, and now you're getting a really good rally. And so that could be a sign that Microsoft is done consolidating and wants to lead the way here. And there's a significant count potential in a number of these. Microsoft has a really nice count. Meta has a really nice count. NVIDIA, Google, Tesla. So it's hard to believe, but it appears that the Magnificent Seven want to lead the way again. And we have in the Qs and NASDAQ 100, we have point figure counts that go to new highs above the 2021 bull market peaks. So that all kind of makes sense.
All right, let's go somewhere else. 4:22, so we have 8 minutes. We'll have to stop right at 4:30. I just have some commitments after this class, so I can't go on after 4:30 today. All right, so let's look at the yields and the Fed rate. And Bruce, I guess that this is the most important slide for me. Everything else is kind of like, it's visible. You could kind of like see this. Why are these important? Well, first of all, the inversion between the yields is suggestive of the recession. So the question is, have we experienced it already in 2022? Are we in it right now, or are we expecting it? And I think that my answer to this would be still expecting it based on these examples right here, where we could see that the red line, the 2-year yield, and the black line is the Fed funds. And with that, we always know that the Fed is going to be always behind the real yield or the 2-year. And then there's going to be a period of stabilization where the Fed is going to just stop, collect the data, and we're close to that I mean, like even from all of the minutes that we're reading, maybe one more rate hike, and it's even 50-50. So I would say like we're in this potential plateau right now, where once the 2-year is going to go below the Fed rate and it's going to start traveling down, that's when we could have some problems. This is when, you know, the big type of market events to the downside happen. And I think that, Bruce, that this, you know, historically big yield inversion is going to translate into something potentially, you know, big here. And we could discuss kind of like the structure, let's say like even for S&P. What if we're still continuing up? And my whole suggestion here with the long-term picture, Bruce, is that we could be doing something like this for quite some time. I mean, like we always think about back to 1970s, 1980s, 60s, before that, right? That big, humongous trading range. Well, this could be a trading range. It's just upsloping on such a much larger scale where every rally actually makes the new high. And then every low is actually making a higher low. So this is just a suggestion for a very long-term structure that could be unfolding for multiple years. It's very crucial for us as Wyckoffans to understand how do we identify the tops and the bottoms. Chris?
Many of you have seen my presentations on comparing now to the analog of the 60s and 70s and how we just kept ramping up inflation. The FOMC notes came out today, and also the producer price index came out, and the producer price index was above expectations. And it's because of energy prices, as we all know. And so the thing that happened today, and I think this is what kicked off the good rally late in the day in the indexes, is that the FOMC notes, which came out 2 o'clock Eastern, was that their language from the notes was that they are wanting to pause, and that maybe there's one more rate hike out there in the future somewhere. But there was a lot of discussion about, well, we may have done enough. And the thing, though, is they're concerned about the disinflationary trends that they were getting earlier in the year are going away because of the higher fuel prices, higher energy prices. So I think what we're looking at, which could be like the 70s, which was a phenomenal trading environment, very Wyckoffian decade, is that we could get a slowdown. I think their language was they're worried about stagflation, and that the strikes worry them, like in the auto industry. The thing is, when you get a negative yield curve like we have, and I put that whole chart in yellow where the negative yield curve is, it's the most negative it got in 2023 going back to the early 80s, is that every time we've had the yield curve go negative, subsequently we've had a recession. And so I don't know if we'll get a recession, but we're going to have a stagflation probably at a minimum, where the Fed stops fighting inflation because they're worried about the economy, and that actually has the effect of keeping inflation high for the foreseeable future. And so they're in a box. And what Roman suggested here, I completely agree with everything he said. The only thing I'll say about the chart on the right is Fed funds in 2-year, is that notice how the Fed funds, the black line, when they start raising rates, they're trying to catch up with the 2-year. And it's like the dog that's chasing the car, and he doesn't want to catch the car. He just wants to chase it, but occasionally they catch the car. Well, that happens at the top, where all of a sudden you have the 2-year get, the Fed funds gets to and above the 2-year. Fed funds gets above. That's a characteristic that each one of those peaks has in common, and we're there now. And that typically coincides with the slowdown in the economy and also with the 2-year starting to fall. I think that the Fed's done raising rates. I think that the interest rate trends that we've seen are just about over, the higher yields, and we do point figure counts on those yields and they're fulfilled. So anyway, that's all I'll say here, Ramon, but you pretty much said what was really important.
Well, let's finish this segment and let's finish the whole class. We're at 4:30. Let me just kind of like see. Okay, maybe like 2 slides and then we're gonna stop. So pretty interesting look. Someone sent me this, someone from our students, I believe, or was it on the social? I already forgot. So this is not my contribution right here, but I thought it was a very interesting idea. United Kingdom's 10-year yield against US 10-year yield. And Bruce, it's kind of like, find, 10 difference on the chart, right? So I think that the UK is leading like it did here. Look at the top here. Where does it come relative to the US? US was stronger, so it overshot this resistance. Same happens here. But ultimately, UK kind of predicted the change of behavior for the US 10-year yield. So, and I'm seeing, Bruce, how with the lower highs here, there is a suggestion that maybe the rates in the UK will start coming down. And that probably would also trigger the US 10 years and other yields, to either be in a consolidation or in the top information already, as we see, starting to exhibit the change of behavior both in the 10-year and the dollar as well. I would argue that, we could argue that we're topping, that's number one, but you could also make an argument that this could have been the highest point right here on the chart. Bruce?
Oh, I love that comparison UK to US. That's really good. Also points out because of the spike up in yields in the US 10-year, why the dollar was so strong. And we pointed out in prior weeks that we had a climactic run going in the dollar. You can really see it in the UUP and the in 10-year yields, but you can see it in the dollar, how you're just getting these like upward gapping moves. And then finally, you have a couple of climactic surges, which were the conclusion of the advance into the resistance of the 2022 peak, and a big reversal taking place now. And also, I think this is the reason that gold was so weak through that period, and now gold's starting to catch a bid, is because of the reversal in the UUP or the dollar. And so this is that's a great combination of charts, Ramon.
Mm-hmm. Yeah. All right, guys. Well, we're at 4:32. Unfortunately, I have to stop here, Bruce. I just have other commitments beyond, the class, the allotted time that we have. Thank you guys so much. For those of you who are new to our program, who are new to our community, please consider, joining us. We would love to have you. You have 1 week for the WMD promotion at $79 per month. For those of you guys who registered since the last promotion and you are at $99, do not worry, we will automatically switch your payment to $79. You have nothing to worry and nothing to do about that. Bruce, final thoughts?
Oh, just thank you all for being here. We really appreciate you coming, and we just have so much fun having these discussions, and hope you'll join us in the future as we continue, trying to unpack these markets. And thank you, Ramon. Great day.
Well, thank you, Bruce, and thank you, everyone, and we'll see you next Wednesday. Bye-bye.
Take care, everyone. Have a good week.